Bear market option strategies. Navigating a bear market can be challenging, but with the right option strategies, investors can protect their portfolios and even profit from declining prices. Here are some effective bear market option strategies. Long put. A long put strategy involves buying put options, which give the holder the right to sell the underlying asset at a predetermined price. This strategy allows investors to profit from a decline in the asset's price. The maximum profit is achieved if the asset's price falls to zero, while the maximum loss is limited to the premium paid for the put option. Bear put spread. The bear put spread strategy involves buying a put option at a higher strike price and selling another put option at a lower strike price, both with the same expiration date. This strategy reduces the cost of buying the put option, as the premium received from selling the lower strike put offsets part of the cost. The maximum profit is the difference between the strike prices minus the net premium paid, while the maximum loss is limited to the net premium. Bear call spread. A bear call spread involves selling a call option at a lower strike price and buying another call option at a higher strike price, both with the same expiration date. This strategy generates a net credit, as the premium received from selling the lower strike call is higher than the premium paid for buying the higher strike call. The maximum profit is the net credit received, while the maximum loss is the difference between the strike prices minus the net credit. Conclusion. Bear market option strategies provide investors with tools to manage risk and potentially profit from declining markets. By understanding and implementing these strategies, investors can navigate bear markets more effectively. Whether through long puts, spreads, or more complex strategies like iron condors and bear butterfly spreads, options offer flexibility and opportunities to protect and grow your portfolio, even in challenging market conditions.